What Eightfold did was the same thing we did twice before, but for reasons that were much less important and exciting to the world than what we have now. To keep things the same as before, you'd be at about $8,400. So when you look at the price chart right now, you think, oh my God, that's crazy. When you put it on a sliding scale chart, like the one we're showing, guys, it's just the beginning. We haven't even come close to the gains we had during those two bull markets. We're not even 40% there yet. That's something to think about. It's not something I trade off of. We might not go eightfold again. But based on how other markets are moving, it's likely that gold will at least stay where it was back then. Do not think that gold is too expensive. The best part is now here. The global economy is much less solid now than it was in either of those earlier times. This means that the current rally might still be in its early stages. Silver packs an even bigger punch in his story. Oliver doesn't look at it by itself. He compares it to gold. In the past 50 years, silver's price has kept going back to a level where it is at least 2% of gold's price. That level has been hit 21 times during both bull and bear markets. Right now, the price of silver is only 1.16% of the price of gold. This means that it is selling at a big discount to how it has historically been related. It's easy math. If gold stays at $4,000 and silver just goes back to its normal 2% rate, silver would be close to $80. Silver's 2% share would be worth $80, $160 if gold goes up to $8,000. Silver prices often go above that, as they did in 1980 and 2011. Thanks for reading this breakdown. If it helped you, please hit the like button, subscribe, and share it with other people who are paying attention. We're going to keep giving you sharp analysis and voices that really know what's going on. Thanks for seeing. Transcription done by https://otter.ai. You're telling yourself, God, this can't last forever. To compare, a ratio scaled figure shows the percent gain of a bull market. If you go back 50 years, when the government gave us permission to trade, you'll see that there were two bull markets with eightfold moves from bear low to bull high, but they lasted different amounts of time. One was from 1976 to 1980. The other one went from 2001 to 2011. But both of them were eightfold wins for gold. We hit a low point of 1,045 in December 2015. If we get eightfold, it just did what we did twice before, but for reasons that were much less important and exciting to the world than the ones we have now. To keep things the same as before, you'd be at about $8,400. So when you look at the price chart right now, you think, oh my God, that's crazy. As you can see, it's just getting started when you put it on a logarithm scale chart like this. We haven't even come close to the gains we had during those two bull markets. We're not even fourfold yet. That's something to think about. Don't trade on it because it's not. We might not go eightfold again after all. But based on how other markets are moving, it's likely that gold will at least stay where it was back then. Do not think that gold is too expensive. When you look at that chart, it shows you which month's close was the biggest for silver compared to gold each year. We figure that out by splitting an ounce of gold by an ounce of silver. Write it as a percent. On the left, you can see that the number goes from 0 to 7 or 8 or something. Also, these bars show your best reading from each year. At 2%, the bottom straight line on that grid chart shows through. In the last 50 years, it has hit 2% 21 times. We're at 1.16% right now. Okay? You can say that we're very repressed and depressed compared to that standard. Okay? During bull markets, when silver prices rise compared to gold, like from $79 to $80 in 2010, 2011, and again in the 1980s, they reached 6% or more. Okay? I'd go with 2% because we've been there 21 times in the last 50 years. And many of those times there weren't even bull markets. That's almost twice as much as silver is worth now in terms of gold. When that spread breaks out, which is hard to see on that curve, that's what usually happens. When we look at the spread along week-to-week or month-to-month timeframes and use an oscillator to study its motion instead of just looking at the spread itself, we can see a level just above where we are now that tells us we're going to gush. We're moving very quickly toward it. In fact, the difference between silver and gold has gone up a lot since April. Also, silver is worth a lot more this year than gold. It's getting there. On the other hand, that spread has a level that says, I'm going to launch. In our weekend updates, we also say what the number is. You will gush up to at least that 2% amount as soon as you do that, most likely even farther. But let's say we stick with 2%. That's almost twice as much as where you are now. So let's say gold stuck at 4,000 and silver dropped to 2%. You can do the math. Okay, $80. Let's say that gold goes through its regular 8-fold bull trend and silver goes to 8,000. This is something that it has done twice before. Remember, how much is 2% of 8,000? Okay? Silver is also a long way below its high point in 2011. The miners just beat their best score from 2011. GDX, XAU, and gold are all much higher than their 2011 highs. Even copper, which is a very base metal, is moving above its 2011 high price. Is silver always going to be a dog? Is it wrong? You and I both know that if you stay in the market long enough, there will be times when prices are too high on the upside and you're wrong, and times when prices are too low compared to other assets and you keep ignoring them until they finally wake up and you think, gosh, I wish I'd known that. Whoosh. And silver? Our case is based on technicals. Silver is likely to surge past 50 and be in the 60 to 70 range by the end of the year. This year, the price of gold has taught us how to be patient. Michael Oliver says that the price of gold dropped for almost 5 months after rising to about $3,400 in April. A top was called over and over by traders, but what looked like exhaustion was actually just consolidation. Even though gold was moving sideways, the excitement was happening somewhere else. Miners went crazy, and silver quietly broke out of a range that had been in place for a year. In just a few months, it went from being in the mid-30s to around $43. Gold didn't move much, but the next part of its journey was already being planned. Oliver says that one of the main reasons for this strength isn't individual traders, but institutions. These are big asset managers who, even though most of them don't think of themselves as gold fans, have started putting as little as 2% or 3% of their portfolios into mines. That might not seem like much, but in this narrow area, it makes a huge difference. Brand names like Newmont have gone up, but it's not because a lot of individual buyers have bought them. Instead, it's because big investors are finally paying attention. It's so small compared to the world's capital pools that even minor moves act like a fire hose hitting a teacup. What did Oliver learn? The break in gold prices is over, silver prices have already begun to rise, and miners are riding the institutional momentum higher. We need to go back to the interview. There has never been more use of power than there is now, and yet it keeps happening. Okay? To make things worse, you can keep making the same mistake, and it's likely that the longer you wait, the worse the outcome will be. But once more, the question is when. Okay? Yes, that's the truth. Those are things that are true. But once more, when? That's what we're concentrating on. I agree that it's important right now because we know what will happen to the central bank when it breaks. They're already crazy, but they're going to get even worse. In this case, they will lower rates, but they will also make more money available, etc. Anyway, that will have an effect on more than one market. Because if they step on the gas, the metals, especially gold and the money metals, will speed up even more. They're not counting on it though, because they already know what will happen. The money has already begun to come in. By the way, it's not really American money, but some parts of the world have put their money into metals. Hold on until that starts. I believe it has already started. I believe this is the reason why gold mines have gone up, especially since April. Remember that gold hit a high point in April, when we talked last. I think gold was up to 3,400. It didn't move at all for 5 months. They sold it over and over and thought, oh, this is the top. It wasn't the best. It was just a dull range. What took place since then? Gold went sideways while miners blew up. Silver went down from the mid-30s to the 33 to 34 range for a year. In fact, it had been up to 3,270 in May 2024. That means you could draw a line across that high and do this on either side of it for the next year. And the highs didn't come until late June or early July. In July, August, and September, silver goes from being in the mid-30s to what? 43. Okay, so gold did not move. Gold is now beginning to make a comeback here. The money that went into gold mines, on the other hand, probably came from asset managers, especially the bigger ones like Newmont, which has been going up for a few months now, because they know what you just said. There are too many points of extra. I'm going to put 2% to 3% of my money into gold mines. They seem to be underrated. Things are going well for gold. I'm not a gold bug, but I am going to move some money over there. But when they do, it's time for a wet bar of soap. Because it's such a small area, squirt to the upside. And I think that some of the power behind that comes from asset managers in the stock market who aren't sure what they're doing. Not able to prove it, it's just a guess. It reached a high point of 115 in 2022. Still, it was low compared to many years ago. Okay, it dropped quickly in 2023, reaching a low point of 100. From there, it stayed there for the rest of 2023, 2024, and early 2025, staying between 100 and 108. While they won't go all the way up to 110, most of the action has been in a very dull area of 7% to 8% for the past 2 years. A lot of other markets were changing a lot. It didn't matter. When it went back down from its early year highs to 104, it was actually the end of March at 104.21. It became very bearish for us. When it comes to price, you're only in the middle of the last 2 years' range. It said you were gone though, so the progress stopped. Price hasn't yet. The annual growth of the dollar stopped. You can use the 10-year average momentum of the dollar, which is an even longer-term way to measure momentum, to find trends that went back 10 years or more. You broke a beautiful rising line even longer ago, you could see on speed. It's not shown on price. What's been going on with prices since the drop in March and April? We made a low point in April, which was also the low point for the stock market. The dollar fell sharply along with the market. The dollar tried to move up and down with the stock market. Since April's low, it has been going up and down in a range of 4 or 5 points. It has been below that level and above that level. At every rise, everyone said, the dollar looks good. You could draw a rising line on a dollar price chart that goes back 10 years if you were really stupid. They did it. And since the low point in April, they've been buying it along that rise. It doesn't look like it will hold. We've traded back below 97 this month, back to the move's lows. I don't believe you will hold out this time. And when the price guys finally figure out, oh, my trend line isn't holding, let's say you end the month at 96.50 or 96, which is a little less than where we are now. They are going to see that we were wrong. That line didn't make sense. Things are already moving so quickly that it won't hold. We think that prices could drop into the 1970s again, or even make a new low below the low from 15 years ago. This would cause problems in other types of assets. We've been gloomy since 104, just like you said. You've lost a lot of points, but it's not really that big of a deal. When it comes to waves, the next 20 points could be earth-shaking. That's when it will start to have an effect on other markets that haven't been drastically changed by the dollar's shift so far. Once more, this isn't a real dollar amount. In terms of money, this is worth more than other types of paper. 70% of the dollar index is made up of the euro and the yen. All of this is connected by the idea that gold and silver are not just rising. They are following a pattern in history that keeps happening in bigger waves. It doesn't look like gold is tired after its big jump in April. Instead, it looks more like it's taking a break, which has happened in the middle of other supercycles. Silver is already giving hints about what will happen next by violently snapping back when it falls too far behind. Big institutional money jumping into miners all of a sudden shows that this cycle isn't just small investors trying to catch the wave. There's more to it than that. From what we know about the past, both metals still have a long way to go, and the institutions that are joining now may only be the beginning, not the end. So stay tuned. click like and subscribe to make sure you don't miss the weekly updates if you like real, data-based views on the financial system. Thanks for your help, and I hope you enjoy the film. Typed up by turboscribe.ai. To get rid of this message, go to GONE Unlimited.